All right, everyone, welcome to the 2.1 meeting. So this is your introduction to Chapter 2. And in Chapter 2, we're going to learn, well, a lot. Chapter 2 is the base and the foundation to, well, Chapter 3, Chapter 4, Chapter 5. Especially this meeting right here. Because in this meeting, we're going to be learning about M&A, which is what we're going to dive extensively into in Chapter 4. We're going to learn about LBOs, which is all of Chapter 5. And we're going to learn about private equity, which is attached to LBOs, essentially. In Chapter 3, we're going to learn all about initial public offerings, or if anyone has heard the term capital markets before, that's essentially raising money for companies via equity or debt. We talked about that in 1.2 a little bit when we listed our different types of securities that investment bankers will issue. So I wanted to start off today's meeting by announcing officer positions. So everyone did get an officer position, fortunately, who ran. So I'm going to start with curriculum. So our curriculum MD, drum roll, is David Ju. All of our curriculum candidates, by the way, were absolutely fantastic or amazing. It's almost impossible to pick between the two, but sometimes you just have to make that executive decision. And our curriculum VP is Shane and Spiegel. Congrats, Shane. All right. Our curriculum associates, Reed Ingersoll. And our curriculum analyst will then be Luna Chang. You can also drum roll for that. Awesome. Congrats to everyone. Luna Chang, there we go. Congrats to everyone who did run. We're going to have officer meetings starting next week, and we have an officer meeting prior to every single meeting. You're going to learn a lot. I promise you'll especially learn something every single officer meeting, and I'm really excited to present with you guys. Now we're going to get to graphic. So if you ran for a graphic position, raise your hand. There are 2 people here. Okay, perfect. So who got graphic MD? Well, I guess we're going to have to do a drum roll to find out, right? Drum roll. And your graphic MD is Aaron Gia. All right. And then your graphic VP is going to be right over here. Congratulations. Both of you guys did a great job. They're both executive positions. And I'm looking forward to you guys recruiting your analyst and associate next year when you guys start running the club. All right. So now that we've gotten started with that, we can get started with this. Again, this is our website. So from this club, we segued into creating our own website where we've expanded chapters, well, all around the nation, and we're about to expand some international chapters into India, which is really cool. Also, this is our link tree. So this is where you can find our Google Classroom, aka where we post our YouTube videos. So you can also find our YouTube. In the case that you ever miss a lecture, you can always catch up then and there. We also have our Instagram on here. We have like over 60 posts on our Instagram. We post very consistently. So just make sure to catch up on that. You can scroll through a few of our reels. Of course, help the algorithm target more people. But let's just get started with mergers and acquisitions. Why do I love mergers and acquisitions? Maybe because it's one of the most profitable industries in the world, just maybe. Private equity is also one of the most profitable industries in the world. But mergers and acquisitions specifically is so exciting because this is where you're seeing companies combine together, companies split apart. And we all know that companies are very, very, very expensive things, right? So of course, there's going to be a lot of money involved in this. So like I did kind of explain, mergers and acquisitions is the combination of companies joining together or becoming acquired by a bigger company, companies selling themselves to other companies, etc. And we're going to break this down even further in Chapter 4. So don't worry about understanding it too much now, but I'm going to dive a little bit into a discrepancy you may note here. So when a company merges, this generally entails 2 companies of similar sizes, combining together, whereas when a company is being acquired, it's usually a really big company that buys a smaller company, meaning that we can introduce a new topic, hostility, right? Does this smaller company really want to merge with this other company? And that's a question we're going to be, finding the answer to in Chapter 4 when we talk about forced mergers and shark's blood, shark bait, things like that. It's really, really interesting. And why do companies look to merge? Well, because of these 3 reasons generally. So first of them being becoming larger faster. Look, building a company from scratch is really hard because you're factoring in so many things, right? How many workers do I need? What am I going to produce? What even is my idea? Sometimes if you're a really big company and you already have capital, you want to buy a company that well, has already established its method of production and has established its name, aka its ethos. So a really great example of this is Microsoft's purchase of LinkedIn, right? LinkedIn, as we all know, is a professional social media site, or a place where professionals essentially get to know each other, kind of like Facebook on that end, but for professionals. And Microsoft building LinkedIn from scratch would be tough. Maybe they could build the entire software, but would they still have that name that LinkedIn has garnered, that prestige, which obviously attracts people over? We also have growing a product line as another reason why a company may decide to, well, merge or acquire. A really good example of this, well, growing your product line, which is pretty intuitive, is Smucker's buying Jif peanut butter and Crisco oil from Procter & Gamble. What does Smucker's do, guys? What does Smucker's make? Peanut butter and jelly sandwiches. But why peanut butter? Because of this. They originally only made jelly, right? But they decided, look, the 2 and 2 are so ubiquitous, they go together. I have to be selling both of them because I can make more money. Hence, they bought Jif peanut butter and Crisco oil from Procter & Gamble. And we're going to talk about how exactly a company can be bought. Next unit, we're going to talk about what specifically does that entail. How much stock do you need to buy of a company in order to really own it? We're going to talk about holding companies very soon, right over here, when we dive straight into geographic expansion. Sometimes companies may merge or acquire because, well, they want to geographically expand. It's kind of like a bulge bracket bank, right? When we get to Goldman Sachs, when we get to JP Morgan, Chase & Co., so on and so forth. Why are they called a bulge bracket? Not only because they're the biggest literally when it comes to services, but because they're the biggest because they're all over the world. So that is one reason, right? You might want to buy something that's over there or over here just because you get a new market that you can sell to. And a good example of this would be Berkshire Hathaway's acquisition of German motorcycle maker Detlev Louis Motor. I'm just going to screw that up, for 400 million euros, right? Can anyone tell me what Berkshire Hathaway is? Because it's not really a traditional company. There's a certain term that we attach to it. And we're going to learn about these terms specifically in chapter 4. Like, has anyone heard of horizontal integration, vertical integration, conglomerate integration? Wait a second. Conglomerate. There we go. That is what Berkshire Hathaway is. It's a conglomerate. It's a company that owns multiple other companies or subsidiaries. We're going to talk about the method by which you can own multiple companies. What does that even mean? Well, we're going to tackle that in chapter 4. But another word that is synonymous to conglomerates, I like synonyms like securities and investments, so on and so forth. Another word synonymous to a conglomerate would be a holding company. So the 2 and 2 kind of go together. Nicholas, did you have this slide? You did the next one? Okay, I'll just cover this one then. Okay, investment bankers are looked at as corporate matchmakers. What does that mean? That means they're a middleman, essentially. What are investment bankers always doing in the world of capitalism? They're playing that person that's in the middle, which is why they're so important, because that's how they involve themselves in every transaction, take a cut of it, make money for themselves, right? They're salesmen at the end of the day. So investment bankers are looked at as corporate matchmakers. Many times when investors or companies are looking to buy other companies, or when companies themselves are looking to sell, they turn to investment bankers. So what are some things that investment bankers do in this process? Well, one really big thing in the process of M&A, to be more specific, are due diligence services. Guys, we learned all about what due diligence services may entail, what financial reports, documents, ratios may be in there in 1.3. Right? So if you want to remember statement of cash flows, income statement, balance sheets, so on and so forth, these little bits of data that investment bankers use to, form a discounted cash flow analysis, make sure that you watch that video. But all due diligence services are investment bankers aiding buyers in determining a proper price for a company. That's respective to M&A, right? When you're buying a company, you want the investment banker to look at their financials so that they can determine, hey, look, is this company worth it or not? That's what due diligence is. Matchmaking services are when investment bankers utilize their network to find possible buyers or someone that may want to sell a company of some sort. Guys, I really want to highlight the word network right here, because something about finance that I would say is unique to other industries is the network that you can establish and how big of a role that your network does play. I mean, like, I know so many personal stories of finance. Now, I wouldn't call this nepotistic, but what I would call it is someone utilizing their network in order to get where they want to go. I've known so many people that have gotten internships, that have gotten analyst positions, or at least something that aided them in getting that position is knowing a managing director at that company and saying, hey, look, you know me, you know that I'm going to put everything I can into this position. You know my qualifications. Can you please, fly me out for this interview in Washington, D.C.? And it has happened. I have seen it, right? And that is just networking on an individual level. That's why LinkedIn exists, right? Right over there on the previous slide. But investment bankers on that macro scale at an investment bank will utilize their network in order to find buyers and sellers. That's why it's important for investment banks to not screw up and not screw people over, because it tarnishes their reputation and it hurts their future business. Now we also get to lining up investors. So this is another thing that investment bankers will do in that mergers and acquisitions process. So when a company wishes to raise money via the sale of securities, investment bankers are often looked at to find the right investors to buy securities being offered. Guys, what does that have to do with mergers and acquisitions, right? This sounds like an initial public offering. Well, buying a company is expensive, right? And let's say an investment bank is helping a bigger company acquire a smaller company. Well, they're going to say to that bigger company, how are you going to get the funds to do this? Maybe you should sell some securities, which I can facilitate because I'm an investment banker and I'm a really great middleman between that entrepreneur, aka you that's trying to do something, and that investor that's trying to make a return on his capital. That's why this portion is really important. Investment bankers will play a pivotal role in this.
All right, guys. M&A General. So you got some strategic buyers, larger companies that buy other companies to get in a new market, etc. Similar to Ion's analogy. Smuckers. They made jam. They wanted to make peanut butter, so they bought Jif. They bought Jif peanut butter, right? Boom. That's one of it. Or you could do geographic expansion. Maybe you have a company and you want to go into like Canada, right? You see Canada has their own market that they're really good at, and you want to get into that market. You buy that company, and you're in Canada now. Investment banks are brought into these deals to help raise money for them or to advise on whether or not the merger is sensible. This is kind of like due diligence, right? They do their research to see what the other company may be worth or stuff like that. At times, the target or the company being looked at doesn't want to be purchased. This is when the deal turns hostile. The service of the investment banks are imperative in these scenarios. At times, buying these companies require more cash and brinkmanship, right? So this, we'll learn about hostile takeovers a little later in the year, but basically it's like the company being bought doesn't agree to it, and you just buy a bunch of shares, and you take ownership of the company, and that may cost a lot more money than if they both agree on a deal. You negotiate, and brinkmanship is basically like applying a bunch of pressure on the company that's being bought. So like a take it or leave it deal, kind of like okay, we can buy you for this, or we don't buy you at all, and you might not succeed in the future. You might not grow as a company.
Perfect, beautifully explained, Nicholas. So yeah, I have no further notes on that slide aside from this bottom portion kind of referring to an acquisition more so than a merger. When two companies merge, that kind of implies a positive connotation where both of the companies mutually agree to combine. Whereas an acquisition, sometimes they mutually agree, sometimes they don't. Hence that hostile term right over there. So now we're going to talk about leverage buyouts. What's up, Reed? Yeah. And that's what we're going to get into in chapter 4. How badly do you want that company, right? And how much brinkmanship is this investment bank going to use? How far are they going to push it? We're going to learn about poison pills, poison puts. So specific strategies that companies may use to acquire this company. Look, it's a dangerous world, right? And if you have a really good idea, safeguard that idea and build it. What's up? Some of them are. So right here, a lot of companies will acquire other smaller companies and develop into a monopoly. That is really possible. And we're going to learn about that in chapter 4, and I'm going to talk about antitrust laws and the certain limitations when it comes to acquiring multiple companies, so on and so forth. But yeah, that's a really good question. So does anyone remember what the word leverage means? What does the word leverage mean? I know you remember. What's up? And that's one of its definitions, right? And that other definition that I'm going to talk about a bit more right now plays into that. So leverage is a synonym, or it basically means debt, right? And I love synonyms and definitions. So what does it mean if I'm buying something leveraged? It really just means that I'm using debt in order to buy this company. And, talking about his definition of leverage, which is something we're going to talk about a little bit later, it's a double-edged sword. If you have debt, you can really use that. Well, if you take money from someone, which thereby puts you in debt, you can use that money to, well, fund certain ventures that can make your company more profitable. And the latter is also true, right? If you use that money incorrectly and it doesn't help your company, well, you can lose a lot of profit, lose a lot of money, and maybe push yourself into bankruptcy, which is something that nobody wants. So yeah, now actually talking about the slide, right? A leveraged buyout is a form of corporate buyout, buying a company with a large amount of debt. And then this debt is then paid off by the cash flows of this company. That last sentence, really important because it puts the company that you've just bought on one of those like spinny wheel things that hamsters run on, right? They need to make sure that they're profitable. Otherwise, everything's going to go wrong because you're not going to be able to pay back the debt that you bought this company back with. I know that this kind of sounds boring, but why is it important? Because it ties into private equity. Private equity, another one of the most profitable industries in the world. House flipping, but scaled up quite a bit. You're flipping companies and making lots of money. So leverage buyouts are done by financial sponsors, and I'm going to tie that to private equity in a second. Financial sponsors have limited partners, aka investors that provide them with money for that leverage buyout transaction. The most common financial sponsor is a private equity firm, and these firms use the cash from their limited partners and some debt to, well, now this is what private equity firms do: buy companies, fix them, and sell them for a profit. Car flipping, scaled up. House flipping, scaled up. Now you're making millions of dollars doing the same thing for companies. Now, what is a management buyout? When the management acts as a financial sponsor, kind of like a private equity firm, but they're not really buying their own company and then selling it and flipping it and then selling it for a profit. They're just buying their own company from investors, possibly using the money from other limited partners. And sometimes the management can include the CEO when we're talking about management buyouts. This actually happened with Dell. Guess what, guys? Michael Dell went to our school. That's pretty cool. We're teaching this, in absence of his presence. But this is a really big thing, and it happens with really big companies. So it's kind of important to take note of. So now we're going to talk about private equity. So we kind of defined it previously, and you guys may have learned about it a little bit as we were talking about it and subtly mentioning it in chapter 1. But private equity firms are investment managements that buy and manage both public and private companies. Although the word private may kind of refer or make you think more about private companies, no, it's both. And we're going to talk about what it means to be a private company and what it means to be a public company in next week's meeting in 2.2. And I'm going to make sure to show that to you on the website so you can kind of get a little bit of a glimpse of it. But investment management that buy and manage both public and private companies and later sell them for a profit. So they flip them. They manage these companies on the behalf of institutional investors and high net worth individuals, aka investors, they're limited partners that provide them with money so that they can do the transaction. So what are some companies, some realistic examples? KKR, this is commonly known as KKR, TPG Group, Blackstone, Carlyle Group of Goldman Sachs. Wait a second, wait. Goldman Sachs is an investment bank. What does this mean, right? What question you should be asking yourself while I tell you something is, how the heck does this relate to an investment bank? Investment banks are profit-making behemoths. They want to make as much money as possible. Recall in 1.1 when I talked about, I would write, but I feel like it might be a pain. I can just explain it. Just make sure you turn your brains on for this one. Recall in 1.1 when I talked about the menu of services that an investment bank often provides, and one of those services being investments themselves. So again, investment banks are profit-making behemoths. They're going to try and complete as many services as they possibly can to make money for themselves. And one of those things is investing in other companies via private equity firms. So sometimes Goldman Sachs may have a private equity firm of their own, and that's commonly known as the Carlyle Group. That is the firm that's attached to that. So how do these private equity firms, sell that company after they've flipped it? One really big way is essentially mergers and acquisitions, right? You're selling to that strategic buyer. Another big way is initial public offerings. Does anyone know what an initial public offering is? Relates to capital markets. Kind of talked about it for a while, but if you don't remember, that's fine, because we're going to talk about it in chapter 3, and that's when I'm going to hope you guys remember it. Initial public offering. What's up, Reed? Yeah, basically. So initial public offerings are what allow companies to, put their stock on the stock market. Prior to a company going through an initial public offering, they're private. When they go through an initial public offering, they're public. What's the difference between the two? now the public can purchase the stock of that company. So one thing that investment banks are renowned for is them facilitating the transaction of an initial public offering, making the stocks that you purchase today available on the New York Stock Exchange, available on NASDAQ. You couldn't be an investor without them. So what private equity firms will do is, in the case they can't find a strategic buyer in a bull market, they're going to do an initial public offering, sell off that company, sell off its stock so that, it can make a lot of money off of that. That's one way to release it from the private equity firm's grip. Does anyone know what a bull market is and its counterpart? Bull and bear markets? What's up, Crawford?
So bull market is bear market.
Essentially, yeah. Why? Because a bull thrusts up and a bear claws down, right? So that just represents, the bull thrusting up represents markets doing great. Bear clawing down represents markets sucking, which just means that the stock price is either higher or lower, depending upon the two, right? And you obviously want to sell to the public when the stock price is higher because you can make more money. Now we're going to talk about recapitalization. So in the case that 1 and 2 don't go well, and you're going to have to keep this company on you, you're going to have to figure out, well, how am I going to efficiently manage this company in the meantime prior to selling a buyer? And that's what we call a recapitalization. So at times, private equity firms cannot find a buyer, so they may restructure the makeup of the company's financing. Does anyone remember what the word finance means? It's kind of funny because we're teaching corporate finance. This introduction to investment banking is corporate finance. So does anyone know what finance means? Well, the duality of finance hinges on the differing meaning of its noun and verb. As a noun, it means to, manage money. But as a verb, it means to fund a venture of some sort. So right now what we're talking about is that noun portion, because we're trying to manage the money that we currently have. And sometimes we're just lacking that money, or sometimes we don't want to owe money to a bank. So what we're going to do is, instead of owing money to that bank, we're going to take on another investor and maybe give them a bit of equity within the company so that we don't have to worry about paying off a loan, paying off interest, so on and so forth. And that's a recapitalization. That's an example of one, at least. You're managing the company's financing in a different way.
So you may be asking, right? Investment banks and private equity firms, like, how are they going to interact with each other? Well, a private equity firm, right? They're going to have various companies, and if they need to dispose of those companies, or if they want to buy another company, that's where the investment bank comes in, hooks them up with a buyer, or gets them on the market in an IPO. And then what are some good aspects of having debt? Well, you can use that money that you borrowed from someone and buy stuff, expand, grow. Downsides, if you have too much debt and the interest goes up and you can't pay for it, then you're going to be in bankruptcy protection, which is when you cannot repay your interest and you're going to file for bankruptcy.
Exactly. And, just one more thing I wanted to talk about. So this front portion right here just relates to the last two slides we talked about. This right here, bankruptcy protection, what happens when a company goes bankrupt? Does anyone know? I think it was on the Chapter 1 game. It might be difficult to tie together. Maybe it wasn't. What's up, Crawford?
Your assets.
Exactly. And the process of that is called liquidation. Liquidation is when a company bankrupts and it has to now sell its assets. Recall 1.2, when I talked about the different securities that do exist, and I drew that graph. I said that debt security holders kind of get that highest value, whereas hybrid security holders are next in line and equity security holders are the lowest. That's where this ties into. If you're a debt security holder, you're going to be at that top of the list to who do I need to pay back in the case that I have to liquidate my company. And likewise, if you're an equity security holder, you're at the bottom, and a hybrid security holder, you're going to be in the middle. So, start thinking about what you invest in. And that is about it for today. So, of course, these are your credits. What's up, Reed?
Does an investment bank also help with private equity?
It's possible, yeah, because what investment banks will oftentimes do is their due diligence, right? And their due diligence is important, especially when it comes to, hey, am I going to invest in this company? However, one thing you may want to note is that, investment banks charge a lot for their business, right? So if you're already a successful private equity firm, hopefully you're going to have analysts or someone on your team that can research the company prior to you buying it. What's up, Crawford?
So do investment banks, do they each have consultants?
It's possible, right? Each investment bank is different. Sometimes what investment banks will do is hire consultants, right? There's so many consulting firms, Carney, McKinsey, I'm kind of blanking. I can't remember all of them. Deloitte, Accenture, but that is their sole responsibility. Hey, how can I guide you through this process? In fact, last year, if you're in Coach Larry's accounting 1 or 2 class, you get to go on a trip all the way to Deloitte. And at Deloitte, I noticed that, well, when we visited that consulting area, they talked about mergers and acquisitions consulting. Boom, right over here. Sometimes what investment banks will do, because they want to focus more on other parts of the transactions, is hire a consulting firm so that they can, well, aid in that M&A process and get those 2 companies together successfully running. But yeah, any other questions? What's up, Reed?
So, if a private equity firm that's analysts, how much to buy a company, why can't they just do
Actually, private equity firms usually don't have analysts. Sorry, I should have probably mentioned that. Yeah, I should have probably mentioned that. So what private equity firms will oftentimes do is they'll recruit analysts from investment banking firms. So usually they start from associate and then go to the top. However, things have been changing where private equity firms recruit directly from undergraduate institutions, but usually those undergraduate institutions are really prestigious, like the Ivy Leagues, so on and so forth. Because look, when you go into private equity, you start off making what, $400K a year? And then it goes upwards because you make so much money. You're literally flipping companies. So of course you're going to make a ton of money.
So why don't they just recruit, why don't they just recruit people to also sell the company?
Because it takes a lot of research, I'd assume. Now, that's a really good question. That's something we should write down, and I will write that down, and we can ask that to our investment banker. But, I mean, that is kind of the sole responsibility of an investment bank, simply because they have really good resources to do it. And then sometimes, again, they're not selling to a strategic buyer. What if they can't find that company in mergers and acquisitions, right? Now they have to go through an initial public offering. And that may be something that investment banks are a bit more tailored to, right? Private equity firms just want to focus on, hey, how well can I manage this company so that it becomes profitable, right? Yeah. Any other questions? Alrighty. And if you have any questions that you want to be a bit more discreet with, you can, of course, come to me and ask me. But that's it for today. Before you leave, I'm going to quickly show you what it is we're going to be learning in 2.2. So guys, in 2.2, we're going to learn all about private business sales, the gamble of private business sales, so it can be a bit risky, and I'm going to talk about why. Going private transactions, private placements, the initial public offering, so now I'm formally introducing it to you, pre-IPO capital raising, the IB role, and what matters in investment banking. And yeah, that's about, I mean, what matters in an IPO. And yeah, that's about it. Yeah. No, my aunt is actually a consultant. My uncle was a consultant for Deloitte. Yeah.
Is that a good way to go?
And if you are a curriculum officer, then I'll text you guys on the remind, but make sure that you attend next week's meeting and you attend the officer meeting. Monday. Library. Yep.